Mastering Call and Put Options, your guide to stock market success. Welcome to our comprehensive guide on mastering call and put options in the stock market. Whether you're a beginner who's just starting to dip their toes into the world of options trading, or you're a more seasoned investor looking to refine your strategies, this video is for you. We're going to break down everything you need to know, from the absolute basics of what call and put options even are, all the way to advanced strategies that can help you maximize your profits while mitigating risk. Remember, options trading can be a powerful tool for amplifying your returns in the stock market, but it's not without its risks. That's why it's crucial to approach it with a solid understanding of the mechanics and strategies involved. So, buckle up, grab your notebooks, and let's dive into the exciting world of call and put options. Before we dive into strategies and start talking about making money, we need to lay a solid foundation. We need to understand exactly what call and put options are and how they work. Think of a call option as a contract that gives you the right, but not the obligation to buy a specific stock at a predetermined price called the strike price, on or before a specific date, the expiration date. Now, let's say you're bullish on Tesla, you think the stock price is going to go up. You could buy a call option with a strike price slightly above the current market price. If Tesla's stock price goes up above your strike price, you're in the money. You can exercise your option, buy the stock at the lower strike price, and then sell it at the higher market price for a profit. But what if the price goes down? Well, that's the beauty of options. You're not obligated to buy the stock. The most you can lose is the premium you paid for the option. It's like a calculated bet with limited downside. Now on the flip side, we have put options. Put options are essentially the opposite of call options. Instead of betting on the price going up, you're betting on it going down. A put option gives you the right to sell a stock at a specific price by a specific date. So, let's say you're bearish on a company, maybe you think their new product is going to flop. You could buy a put option with a strike price below the current market price. If the stock price drops below your strike price, you're in the money. You can buy the stock at the lower market price and exercise your option to sell it at the higher strike price, locking in a profit. Just like with call options, if the price moves against you, the most you can lose is the premium you paid for the put option. Now, I know this might seem a bit complex at first, but trust me, once you grasp these basic concepts, the world of options trading will start to make a lot more sense. Remember, with call options, you're bullish, betting on the price to go up. With put options, you're bearish, betting on the price to go down. Now that we've covered the basics of calls and puts, let's dive into some key strategies that can help you make smarter, more profitable trades. One of the most critical factors to consider before buying any option is market sentiment. Are you bullish or bearish on the underlying asset? If you're bullish, you might consider buying call options, hoping to profit from a price increase. If you're bearish, put options might be more your style, but it's not enough to just look at the general market direction. Timing is everything in options trading. You need to consider factors like upcoming earnings reports, product launches, or any news or events that could impact the stock price. Remember, options contracts have an expiration date, so timing your entry and exit is crucial. Another key strategy is strike price selection. This is where things get a little more technical. The strike price you choose will depend on your risk tolerance and your outlook for the underlying asset. A lower strike price for a call option or a higher strike price for a put option will be more expensive, but offers a higher potential for profit. On the other hand, a higher strike price for a call or a lower strike price for a put will be cheaper but with less profit potential. It's a trade-off between risk and reward. And speaking of risk, let's talk about loss limitation techniques. Options trading can be risky, but there are ways to manage and mitigate that risk. One popular method is setting stop-loss orders. A stop-loss order automatically sells your option if the price falls below a certain level, limiting your potential losses. Another essential strategy is to diversify your options portfolio. Don't put all your eggs in one basket. Instead, spread your risk by investing in options on different underlying assets or different sectors. And finally, remember that options trading is not a get-rich-quick scheme. It requires patience, discipline, and a willingness to learn and adapt. Now, let's talk about something that's absolutely crucial when it comes to options trading, and that's risk management. Remember, Options trading can amplify your returns, but it can also amplify your losses if you're not careful. The name of the game here is to protect your downside. You want to stay in the game long enough to capitalize on those winning trades, and that means not blowing up your account on a few bad bets. One of the biggest mistakes new options traders make is over-leveraging themselves. Leverage is a double-edged sword. It can supercharge your gains, but it can also magnify your losses to the point where they're almost unrecoverable. Don't get greedy. Start small and gradually increase your position sizes as you gain experience and confidence. Another crucial aspect of risk management is diversification. You've probably heard the saying, "Don't put all your eggs in one basket," and that applies tenfold to options trading. Diversifying your options portfolio is like having a safety net. If one trade goes south, you have other trades to potentially offset those losses. You can diversify by trading options on different underlying assets, different sectors, or even different strategies. And speaking of strategies, it's essential to have a plan for every trade before you even think about hitting that buy or sell button. Don't just jump into a trade based on emotion or a gut feeling. Have a clear understanding of why you're entering the trade, what your profit target is, and how you plan to manage your risk. And finally, always understand the expiration date of your options contracts. Options are a wasting asset, meaning they lose value as they get closer to their expiration date. If you hold an option until it expires out of the money, you'll lose your entire investment. So keep track of those expiration dates and have a plan for what you're going to do with your options as they get closer to expiring. Now let's dive into the exciting world of technical and fundamental analysis and how you can use them to make smarter options trading decisions. Think of technical analysis like reading the language of the charts. It's all about identifying patterns and trends in historical price data to try and predict future price movements. There are tons of technical indicators out there like moving averages, RSI, MACD, and Bollinger Bands, just to name a few. These indicators can help you identify potential buy and sell signals, gauge the strength of a trend, and even spot potential reversals. Now, while technical analysis focuses on the charts, fundamental analysis is all about digging deeper into the underlying company or asset. You're looking at things like their financial statements, their management team, their competitive landscape, and their overall industry outlook. The goal here is to determine the intrinsic value of the underlying asset. Are they a solid company with strong earnings growth and a bright future, or are they struggling to compete in a rapidly changing market? By combining both technical and fundamental analysis, you can get a more well-rounded view of the potential risks and rewards of an options trade. For example, you might identify a bullish chart pattern on a company that's also fundamentally undervalued with strong earnings growth. That could be a recipe for a potentially explosive options trade, but remember, no analysis is foolproof. Markets are constantly changing, and there are always unknown factors at play. The key is to use these tools to make more informed decisions, not to try and predict the future with 100% certainty. And always do your own research. Don't just blindly follow someone else's recommendations. Take the time to understand the rationale behind the analysis and make sure it aligns with your own investment goals and risk tolerance. One of the most important things to remember about options trading, or any type of investing for that matter, is that it's a journey of continuous learning. The market is constantly evolving, new strategies emerge, and what worked yesterday might not work tomorrow. So, how do you stay ahead of the curve and keep your skills sharp? Well, first and foremost, stay informed about economic news and stock market trends. Pay attention to things like interest rate hikes, inflation data, geopolitical events, and anything else that could impact the market as a whole. Read financial news websites, listen to podcasts, follow reputable market analysts on social media, and immerse yourself in the world of finance. The more you know, the better equipped you'll be to make informed trading decisions. Next, make sure you understand the Greeks. No, I'm not talking about the Greek alphabet, but rather the option Greeks, which are a set of risk measures that can help you understand how the price of an option is likely to change in response to various factors. You've got delta, which measures an option's sensitivity to changes in the underlying asset price. Theta, which tracks the time decay of an option's value. Vega, which measures an option's sensitivity to changes in volatility, and so on. Understanding these Greeks can seem daunting at first, but trust me, it's well worth the effort. They provide valuable insights into the potential risks and rewards of an option trade, and can help you make more calculated decisions. And finally, never underestimate the power of practice. You can read all the books and watch all the videos you want, but nothing beats real-world experience. Start by paper trading, which is essentially simulating trades without actually risking any real money. This allows you to test out different strategies, get a feel for the market, and gain confidence before putting your hard-earned cash on the line. Once you're comfortable with paper trading, start small with real trades. Don't be afraid to make mistakes. That's how you learn and grow as a trader. Alright, so you've done your research, you've analyzed the charts, you've identified a promising options trade, and you've entered the market. Now what? Well, now comes the equally important part, knowing when to exit the trade. Many traders get so caught up in finding the perfect entry point that they neglect to plan for their exit. But having a clear exit strategy in place is crucial for locking in profits and minimizing potential losses. One of the most common mistakes traders make is holding on to winning trades for too long, hoping for even bigger gains. Greed can be a powerful emotion, and it can often lead to making irrational decisions. Remember, the market doesn't go up in a straight line forever. What goes up must eventually come down. That's why it's essential to take profits when you're happy with the gains, even if it's less than what you initially hoped for. As the saying goes, you haven't made any money until you've sold. On the flip side, you also need to be prepared to cut your losses when a trade goes against you. Don't fall into the trap of hoping the market will turn around and bail you out. Holding on to losing trades for too long can quickly erode your trading account and damage your confidence. That's where stop-loss orders come in handy. A stop-loss order is like an insurance policy for your trades. It automatically sells your option if the price falls below a certain level, limiting your potential losses. Now, determining where to set your stop-loss level depends on your risk tolerance and the specific trade setup. Some traders use technical levels like previous lows or support levels, while others prefer a fixed percentage below their entry price. The key is to find a stop-loss level that makes you comfortable and allows you to sleep soundly at night. Thank you for watching. Remember, success in the stock market requires continuous learning and practice. Options trading can be a powerful tool to amplify your returns, but it requires a solid understanding of the mechanics, strategies, and risks involved. Don't be afraid to start small, paper trade, learn from your mistakes, and gradually increase your position sizes as you gain experience and confidence. If you found this video helpful, please like, share, and subscribe for more insights and tips on investing. Happy trading!